Hey everyone, this is Mike Del Preti, and you're listening to Context, the podcast where I'm talking to industry leaders about what's changing and not changing in the world of real estate, and today, mortgage. My guest is Garth Graham. Hey, Garth.
Hey, how are you?
Garth is the senior partner at Stratmor Group. So, Garth, tell us briefly, what is Stratmor?
Yeah, so briefly, we've been around 40 years. We're a boutique consulting firm for the mortgage industry, meaning we work with mortgage origination companies, independent mortgage bankers, banks, etc. We provide benchmarking. When you read the horrible news that says something like the MBA Stratmor says the average cost of origination is $12,000, if that makes you sick, I apologize, but that's often our data. Of course, when industry profits skyrocket, you're welcome, because that's our data too. We also do benchmarking around the customer experience. We do technology procurement, so we're pretty well connected in that one industry, mortgage, so hence the boutique part.
What's the biggest thing going on in the mortgage industry right now?
Yeah, so I often do the same explanation for many problems that plague our industry, and I think it is very similar to the real estate industry, and that is it's highly cyclical, it's highly fragmented, and it's highly regulated. And the cyclicality really makes it extremely difficult to manage budgets long-term and costs because you are constantly fluctuating up and down. There has been only 1 year in the last 15 years where refinance volume did not go up or down by 20%. And usually you didn't predict it. And the only year it didn't was COVID year 2, when it was up 120% the first year and then stayed the same the second year. So it is very difficult to forecast. So a huge issue for lenders is how do I react to a changing market condition, which, by the way, is always changing. And the fragmentation problem is really just the high number of originators and mortgage companies, although we certainly are beginning to see some consolidation, and I think that's a very similar thing that the real estate industry is experiencing as well.
So I've worked with one of your guys, Brett, on a lot of secret shopping stuff recently. And so how much of your business is secret shopping, and what do you find from that?
It's a growing part of our business. And I think really what it is when you see some of the biggest lenders like the Rocket and Redfin, Mr. Cooper transactions, and I was just at the Housing Wire conference, and the three of them were up on the stage together for an hour, so, viscerally got to experience their messaging on this. But they're making big bets and owning the customer experience from start to finish. It doesn't mean you have to make the same bet. Not many will. But every lender needs to be optimizing the experience for the consumer. And what Secret Shopper shows you is what it really is like from a consumer perspective, because it is not as good as many of the lenders think it is. And it's your classic people, process, and technology. The customer experience when they talk to a loan officer maybe is subpar. The loan officer says, I'm going to call you Friday, and then does not. They have a conversation with the loan officer, and for some reason the CRM doesn't get updated, so then all the automated marketing is broken because of this one little easy thing. You don't see it unless you experience it, and that's what we do. We replicate and go in and do the customer experience. It is an absolute wow.
Why does it matter so much?
It matters so much partially because you will spend bad money after good money and keep buying leads or keep investing in recruiting loan officers or keep paying loan officers high fees, high commissions, and you'll keep doing it over and over and over again. And when the market's bad, you'll spend more money on leads, but you haven't even optimized your lead funnel or your ability to engage with the customer at the LO level. By the way, every time I sit there and say something about an LO and somebody wants to reach out and kill the consultant guy, I was an LO. So that's where I started at sales. So my DNA is like, how can we optimize this sales process, or how can we give a better experience for a consumer and drive it out? And otherwise, what you see in this cost in many cases is low productivity, low conversion, inability to maintain pipelines for this long nurture cycle for real estate. And it shows up so acutely in the secret shopping process.
I'm sure a lot of people look at that and are thinking like, oh yeah, but we'll just muddle through. Like we'll grind and it'll be all right. Maybe we don't get back to people, on time, or maybe it takes a day or two. I'm sure you've seen a lot of examples. Like, can you share an example of that monetary ROI between a company that's really nailing it and not?
Oh yeah, absolutely. So it's at least $1,000 a loan in marketing cost per funded loan between someone who's got good conversion versus poor conversion on the exact same lead set. And by the way, I don't want to sound like a complete bummer here, especially since it's going to be recorded and available for people to, rewind and listen to it again. There's some companies that are really, really good. And one of them is one of our bigger clients And they pay us to secret shop them despite the fact they know they're good. Because we always find little elements that they know they can be better. So what does that say about them culturally? They're constantly striving to improve, and they are one of the best in that space. So I would challenge people, you're usually worse than you think when you go through the secret shopper experience. And usually it is a missed opportunity, people, process, and tech. But on a purchase loan especially, the missed opportunity is to engage with the consumer on an empathetic level and to achieve their financial goals. Their financial goals never is to get a mortgage. Their financial goal is always to buy a home on purchase. Refi is a different style. But if your people miss that opportunity, they're not going to engage. They're not going to get that loan, and they're not going to get the next loan from the realtor. And they're probably going to be one of those many loan officers who switch jobs because they're just not able to connect with people. And, you have to test it. If you think it's important, you got to test for it.
So I'm sure you've seen a lot of examples. What's the biggest needle-moving example difference between, some company offering an okay experience and a great experience?
WHY. Why? And the reason is, if you are good, you are able to connect with the consumer through your systems or your people or your process and understand why they are trying to buy a home. If you don't ask on a web page, on a phone conversation, you don't document it in a system, and you don't leverage it when you engage with them people-wise, the why, then they're just going to keep seeking that connection somewhere because it is not a super easy transaction. They're trying to buy a bigger home because they're having a kid, a smaller home because the kid left home, a bigger home because they have to go back or closer to work because now they have to go back to work, farther away because they don't have to go back to work. Whatever it is, there's something they're trying to fulfill. And realtors, the high-producing realtors are naturally able to do it, which makes them high producer. But it's beyond the technical part of the loan application. It's WHY. Why are they trying to do it?
I'm surprised it's not time to call, speed to lead, anything.
I mean, some of those are table stakes. I mean, those are the binary fails. I think speed to lead is, once again, someone's going to be first and everyone else is not. And at some point, it's engaging with them on what it is they're trying to accomplish. The really scary thing I would say, and we have an evolving practice around this, and it's evolving because of the evolution of the technology, is the ability to leverage AI to be able to do things so much more efficiently that you're freeing up opportunities for humans or the AI itself to engage with the consumer. And that's a wow.
Are you seeing that in practice?
Yeah, we are seeing it in practice. There's 2 or 3 lenders who are doing it at scale.
The AI sitting in the background, or is it talking to consumers?
Most of it's sitting in the background. There is some, like as I say, evolving that are, if somebody can reach out to me on LinkedIn and we could send you a sample file or a phone number you can call and experience it yourself. But you are absolutely beginning to see the agent part too. It is still not going to do the great job of the why, except it will ask the question. What it does a really good job is it's instant. They don't have to leave a message. They're beginning to get some trading information back. And the other thing with the AI, like everything else, and this begins to get into the wow, how our world might be changing, they don't hear obstacles and they don't react to an objection the same way a human does. Because we will literally have these workshops where they'll say, well, the problem is my leads are no good. And then we secret shop and we're like, well, that's a problem, but not the problem. Well, the machine's not going to ever say that. It's just going to keep hearing when someone says, oh, I'm calling, I'm following up on this opportunity. Where are you in the home buying cycle? And the customer might go, so where are you calling from? A human's like, oh, crap, another bad lead. The machine's just like, oh, I'm sorry. I mean, literally that quick. Oh, I'm sorry. I'm calling from so-and-so. You filled a form out. Or I'm calling from, you did a loan with Robert 9 months ago, and we're just calling to see how it's going in your new home. They'll just pivot that fast. And, consumers are going to react to it and engage with it. Now, some of them won't, but it didn't cost much to try.
If you were training an AI model that was going to be talking to consumers for your clients, what kind of instruction set would you give it?
Well, anything in mortgage banking is, I had a whole sales training module that I did for years. And it really applies to this too, which is you start up front through a consultative process, meaning you're asking questions, open-ended questions. You're not hammering them like, what's your credit score? You're saying, have you had your credit pulled? Are you familiar with, how credit scores work and how they might impact a thing? You're consulting with them and you're getting them to tell you what they already know. You're starting to meet them in the middle. The next item, so you've gone through a consultative process, exactly the same. Then you try to clarify what it is they're trying to do. You're trying to narrow it down a little bit, but you have to trade information, because if it sounds like an interrogation, then they want to get off the phone. But just a little bit. Tell me a little bit more about it. Oh, that's super interesting. Then you compare. So what I've heard from you is that you're currently looking for a home, and you've been looking for 30 days, but you haven't gotten pre-approved yet. So an option might be for us to spend a couple minutes, doesn't cost anything, to get pre-approved on your mortgage, and then the mortgage is waiting for you instead of you waiting for the loan. I just gave a comparison. Here's where you are, here's where you are. And then the close is then let's take action. So, certainly from a compliance standpoint, the third element I said about mortgage banking is regulation. In a compliance standpoint, you have to be very careful about what the human does, because that is your licensed activity, versus what the machine does. But that's beginning to morph.
You're speaking with a high degree of authority and expertise in this space. How do you know so much about what it is that you're talking about?
So one of the big advantage why I love my job is we get to talk to most of the players in our industry, and we have been for 40 years. The other is we have the industry's data. So while we are, I'm talking about empathy and I'm talking about strategy and decisions and humans and people, well, I got data too. So I know the cost of origination for banks versus independents, the cost of every single function within the chain. I think that helps.
What is the cost of origination?
It's about $12,000.
Wow, I bet that would surprise a lot of people listening to this.
Yes.
Why is it so high?
So 50% of that cost is sales. Once again, I started as a salesperson, so you can throw things at you, but I'm just bearing the facts. So 50% of this is sales. One of the problems in sales, and I spoke at the Housing Wire conference just this week, and this is what I spoke about, is we still pay 8% of the loan amount as the primary way that we provide incentive. It's exactly the realtor model too.
So when you say sales, that's going to the LO?
The loan officer, the people who support the loan officer, the people in the branch, there's sales management, but mostly, yes, it's the loan officer. So $1,500 of that cost is because we are paying on the loan amount, and the loan amount is going up by so much more than the rate of inflation. So if we'd have, in 2010, in the last 15 years, if we'd have just indexed where we started in 2010 against a rate of inflation, we'd be paying $1,500 per loan less. So part of the problem is, as this loan amount, affordability, et cetera, keeps going up, so too does compensation, despite the fact that the job's not that much harder. It's hard right now because a lot of tough loans and whatnot, but it's not dramatically, it's not twice as hard as it was 5 to 10 years ago when the loan amounts were half as much.
What's the fall through rate? For everybody that applies, how many actually fall through?
So it's 50 to 70% of applications pull through. It's more like 10% of leads. So the fallout up funnel is high, and a big factor there is borrower affordability and inventory, although the inventory part is certainly waning. But can't find a home or not comfortable with the payments on a home, so I don't end up buying a home.
Is there one factor that's bigger than all the others?
Not really. I mean, generally, I'd say affordability is the factor. And affordability is what's driving the percent of the loan amount, which affects the cost. So it's like a vicious loop. The other is, I'd say, when we look at the study, a couple $1,000s of that 12, maybe 20%, can be sort of lumped into compliance. And compliance is the cost of the regulation. And I'm not going to give editorial on whether the regulations, which ones are good or bad. I'm simply saying the number of them. And some of this, like real estate and like title, is state regulated. So if you got 50 states, you got 50 regulators. Some are aggressive, some are not. And that's even before you get into CFPB, and if you're a bank, OCC, FDIC, et cetera. So it's a complex regulatory environment for which there is cost to comply. So two of them are right there.
Okay. So in terms of that cost of the $12K, you've got 50% for sales, another 20% for compliance. What's the rest?
Fulfillment, which is everybody who handles for that 45-day period of time where you run to closing is collecting pay stubs, W-2s, bank
Yeah.
statements, processing, and underwriting, which is the actual other sort of licensed or certified individual who is technically what an underwriter really does is they are representing the investor who's ultimately funding the loan. So there's that cost is roughly half in processing and half in underwriting and closing, roughly.
What about, where does customer acquisition cost fall?
That's in sales.
Okay.
So for me, customer acquisition cost is sales and marketing.
How much is customer acquisition cost?
So it's the marketing cost, to be clear, marketing cost for funded loan on the retail side is very low because you're paying it in much higher commissions. On the consumer direct side, where the marketing is spent, it's $1,000 to $2,000 a loan.
Out of all of those components that make up the 12K, which one do you think is just higher than it should be?
Sales, and I was a salesperson, and I spoke. So that's why they offer me opportunities to speak, because they'll say, Garth will say something controversial that someone will react to. So you're welcome. And we're indexing to a loan amount rather than pay. And this is what I said to the group. You don't have to do basis points. It's what you're doing. You don't have to. And you could say, I'm going to pay you $2,000 a loan, which is now a unit, which means at least if the sales price is higher, my cost didn't go up. But I can pay you an extra $200 if you get a 5-star review or a high customer sat score. I can pay you a little bit more if you have a first-time approval submission to underwriting, meaning you took a good application and prepared the customer. I can pay you a little more if your time to get a fully loaded approval is faster, which means the customer experience is probably better. But we don't do any of that.
Why?
We just pay the percents, what we've always done. A little bit of this is, it's the path we've gone down, and a little bit it's very aligned with the same thing in real estate. It's the commission level and then the splits, and it's very similar in mortgage. In fact, I have another thing I say about mortgage in addition to my fragmentation, cyclicality, and regulation. It really is, on the purchase side, it's 100,000 loan officers chasing 1 million realtors who are chasing 4 million deals. That's the funnel. So because of the high fragmentation on the real estate side, we sort of have an alignment of a high fragmentation on the mortgage side. I mean, if every loan officer, if we spread it like peanut butter, which is not at all how it is, every loan officer could have 10 realtors, and as long as there's 10 realtors that represent, that I'm getting some portion of their business, I can make a living at it. So it's some of that same fragmentation, and at some point, I think, between technology and everything else, there will be some consolidation of those positions. Do you need that many?
That's interesting. But really, the only reason the compensation structure hasn't been tried a different way is because this is the way we've always done it.
This is the way by the way, in consumer direct, the biggest consumer direct lenders absolutely have per unit. So they've pivoted. And just to give you an idea, some people listening may say, well, there's hardly any consumer direct. I'll give you the number. 65% of all refinances are through consumer direct. 65%. The customer is voted 2 out of 3 times. I'll go through a centralized unit. Purchase is about 15. So the consumer's voting there too. I feel more comfortable with local. And that's really where that alignment between the loan officer and the realtor. But there's exceptions. I mean, there's some lenders that do billions and billions and billions to a call center, and they do it really, really, really well. Some of them are secret shopper clients because they realize they have to use people, process, and technology to create a consumer experience to compete with the comfort that someone might get by being local. So that's a little bit of what that, another element of what that secret shopper is. But it is a resistance to change. It is also, heads of independent mortgage bankers say, Garth, I think you're 100% right. I think someone should do that first. So someone else can jump out first, and then maybe I'll follow them if it works. Nobody wants to be the, first to say, and I think in real estate it would be roughly the same. Do you really want to be the first one to say, let's really go after this, the level of commission on the real estate side? It's hard.
If I gave you $2 million to start a mortgage company today, what kind of company would you start?
Well, just so you know, it takes about $10 million to start a mortgage company, but that'd be the minimum required capital. So we do a lot of finance, so I just had to say that.
Okay.
I really think a model that leverages the advantages of being local with a centralized management discipline like a consumer direct is a winner. And there's some companies that do it. So it is a hybrid, meaning they're really good at thinking about things and centralized and processed, but they also realize at some level it is a local business working with realtors, especially locally, to deliver, this opportunity for the, within a community. So I think that is a winning strategy. It's also a pretty good bridge strategy.
What do you mean about bridge? Just that it's hybrid?
To the future, yes.
Okay.
A bridge to maybe a future where suddenly, we're much more efficient, we're much lower cost.
Are you seeing any on efficiency? Are you seeing anyone out there really improving efficiency?
Sure. By the way, in our peer group, you can imagine we had 50 consumer direct lenders in Chicago last month. And we all are in the room talking about just that. And some of the people in there still are really struggling with productivity and efficiency in certain functions, and some are leading them. And that's a big part of what we stimulate those type of conversations.
What are the qualities of the ones that are leading in efficiency gains?
It is your classic ability to manage large change initiatives or any change initiatives leveraging people, process, and tech. We see all the time people who take a technology solution, one lender A implements it, lender B implements it, it's identical. Lender A's adoption is 80%, lender B's adoption is 20%. That's not tech, that's people and process. So if you build out and look at things across that discipline, which is kind of why I keep coming back to it, whether it's secret shopper, it's people, process, and tech, you can drive change, which really can be impactful for the bottom line. The tricky part in mortgage, going back to whatever number of minutes ago I started talking, it's cyclical. So you'll make these changes and you'll say, this is going to have a big impact on my bottom line next year. And you'll get into the year and interest rates will go down and your volume goes down. So you're suddenly like, wow, I didn't make as much money this year as I thought. Therefore, maybe can I really afford to keep making these investments? So it's tricky. I mean, you got to be super agile, but you got to look at it across those people, process, and tech.
So you've got a lot of data on the mortgage customer experience. What do consumers really hate?
There's 7 things. We've surveyed millions of customers. So I feel like the Austin Powers, millions. I would have my, pinky up to my mouth and give you the whole visual, but this is a podcast. Millions of customers, and we ask them, how was the process? And we ask them at some level of detail. We've got some good technology to extract these insights. 55% of customers say one of 7 things happened, and those 7 things drive, on average, their NPS score down 50 points.
Wow.
So you've literally lost the referral, the repeat customer. You might have lost the realtor because of one of 7 things. I'll give you a few of the 7 real quick because some of them you're going to be like, what? You're asked for the same information more than once. That is a people, process, and tech. So it may be asked on the upfront form and that didn't integrate to the LOS. It could be that you told the LO, but he forgot to put it in the system. It could be you uploaded a pay stub, but you didn't upload the whole thing. But the customer's perception is, I kept getting asked for the same information more than once. That is a killer. And by the way, it's like 1 out of 4 times. It's not good. Other things are the closing didn't start on time. So this classic is like your doctor's appointment. You show up for your doctor, you make an appointment, you took off work. You're already anxious as heck because, you're buying a home and about to sign all this paperwork. You get to the closing, it doesn't start. You sit there for 45 minutes. So you spent 45 days and $12,000 trying to get to the table, and then the appointment doesn't start on time. Now, why couldn't that have been an e-close experience, which never would have had a problem? And by the way, that's growing. So there's an element in that too. You didn't close at the expected rates and fees. That's a bad one. Sometimes that doesn't mean you got ripped off at all. It just means the numbers changed because the closing date changed, the per diem interest changed. A mortgage banker would tell you a million reasons why that's not their fault. It doesn't matter. The consumer's like, that's not what I was expecting. So that's a third one. So if anybody's interested, find me on LinkedIn because there's 4 more. But those elements drive a lot of it. The best lenders, not being contacted prior to closing is another one. The best lenders focus on it and really drive it. Now, if you said, does this really matter? 1 out of 4 customers, sometimes less, but on average, 1 out of 4 customers get a loan from the company they got their last loan with. That's great. 3 out of 4 customers do not get their loan from the company they got their last loan with. So, I mean, whether you look at it in the inverse stat, the glass is 1/4 full or 3/4 empty. So what does that tell you? Well, our data says, 50% of the time, they tell you at closing that it didn't happen. I mean, you did not give me a wow experience. So they're not going to say necessarily, I hate you and I'll never do business with you again. But they're not going to immediately think, I want that experience again. So they'll keep looking for the next one.
Well, and it's the little things too. Here's an example I'll share. Just a couple months ago, I emailed my last loan officer, my last lender that I used a couple of years ago. I said, hey, might be in the market, wanted to go through and get the pre-approval process. That person no longer worked there. Email bounced back.
Yeah.
Done.
That is classic. By the way, I love stats, so you just got to let me riff on this one. There's 142,000 loan officers in our industry who did at least 5 loans last year. So that means let's say they're relevant. That's one every other month. That's not that relevant. The top 30% did 70% of the business. So there's only 40,000 that are doing 70% of the business. And this is also very similar to real estate. But if you look at the bottom half, so 70,000 loan officers, the attrition rate in an annual basis is almost 100%. So yours is not unusual. Wow. That bottom 50% likely pursue their next company because they didn't do real well at the last one. So they didn't necessarily look in the mirror, and I don't know who your person was, and say, I need to be better, or I'm investing in myself, or I need coaching. They say, my company's no good.
Yeah.
And go to the next one.
Same in real estate. That's kind of the number one reason real estate agents change a brokerage.
Yeah, yeah. So it's very similar. I mean, it's remarkably similar when you sort of think about it.
With that breakdown, it's interesting. What makes a good loan officer?
Number one, efficient, organized, and empathetic. Because especially on the purchase side, and a refi, if you're a good refi loan officer, and someone calls up and says, hey, I've got a $300,000, what's your current loan balance? $300,000. What's your current rate? 7. Okay, I can give you a 6% rate, so I can save you 1% on $300,000. I could save you $3,000 a year, $250 a month. Do you want to do it? I did that all with mental math. That's not too far off from almost every conversation. That's not that hard. The purchase loan, it's slow down and get to the why. So the best loan officers have some combination of that tenacity, willingness to handle high emotionally charged transactions, ability to deal with realtors, okay, because they have the same challenge on their side. At some point, a realtor-lender partnership's a beautiful thing when they can work together on trying to make it better for the consumer. But it's really about the empathy to connect with them on what it is they're trying to accomplish, because nobody goes and says, I'm going to buy a house so that I can get a 30-year loan. Right. I mean, right. It's the other way around.
Yeah.
So, focus on what it is they're trying to accomplish before you try to focus on what it is that you want out of it.
Man, this has been great. And the past 30 minutes have just flown by. Any closing thoughts?
I think as an industry, we need to be willingness to embrace change. And that change is, some of it's coming at us fast. And I will tell you, a year ago, for instance, everything in AI was about read the documents, extract the data, and do some calculations. That was where the action was. So they're kind of getting into the automated processing underwriting. We had our consumer direct workshop, 50 lenders in the room, and we're showing them what's referred to as agentic AI, which is the willingness of that near human to have an engaging conversation. And even these people in the industry, there was some wows. It is coming and improving so fast. I bet I will never be on your podcast again because you'll be able to create an AI and say, I want to do a podcast that sounds like Garth, but here's a whole bunch of data that's better than Garth stuff. You won't have to need me again, right? So I'll work on some fresh material to avoid that happening. But I also think as an industry, we have to embrace the fact that this technology can make the experience better and maybe hopefully lower cost for the consumer in the long run.
Fascinating. All right. Thanks for the chat, Garth. I'm Mike Del Prete. You've been listening to Context. If you want to check out more of my podcasts, research, join my mailing list, go to my website at mikedp.com. All right. Thanks.
Thank you.